Hello guys, welcome back to another video. Today's video is going to be a little long, so I want you to grab a snack, grab a drink. We're going to be covering a very important topic, and it's one of the most important topics in trading because this is what's going to be determining your approach to the market, your understanding to the market, understanding how the market moves, why the market tends to go to a certain price, why does it make or print a simple or a certain setup. Okay, we're going to be talking about liquidity. So at the start, what is liquidity? So liquidity, okay, is a place that has pending orders, not from me, not from you guys, not from any other retail trader or an ordinary trader. It comes from the big institutes, the big names, the market makers. So they have pending orders, they have pending take profits. So let's say in the real markets, I'm going to be trying to, come up with simple examples, and at the end of this video, we're going to be going for the practical place where we're going to be jumping all the charts and implementing most of the stuff that we just discussed here, what we can implement, of course. So at a certain price, the big institutes, let's say on the real markets, you buy a certain, let's say gold, let's say a currency at 1, okay, and you come and sell it at the price of 2. So whenever you sell something, now it's available in the market. Now, according to supply and demand, if there's something available too much in the market, there is no rarity. The supply is way bigger than the demand, so the price is gonna go deeper, it's gonna dip lower, okay? Now, on the other hand, let's say you are in a country that does not have, let's say, a production of anything, copper, let's say, or gas. So what happens? The gas and the copper prices in this country are high. Why? Because there is no supply that fulfills the demands. So in order to sell something, okay, let's say it's ordinary prices for etc. Let's say 50, okay, and the demand is way lower than the need, so the price is gonna be higher. Okay, so not all the demand is gonna be justified. Okay, that's in the real markets. In trading, it's the exact same thing. The price comes at a certain price for the big institutes to put their buy orders or to put their buys, okay? So they bought the currency, they bought the virtual thing, whatever it is, okay? And the price comes to a certain price, okay, that the big institutes decide to take profit. Now, after the taking of profits, what happens to the thing? What happens to the currency or the metal or the indice or whatever? It's available in the market. It came to a supply area. So that supply area pushes the price low because it became available again in the market. People are tending to take profits. This is from the fundamental or the basic analysis. Jump into liquidity, okay? So in liquidity, big institutes are tending to buy gold, let's say at a certain price, let's say 4,000. So whenever the price comes at 4,000, okay, the pending orders of buys of the institutes gets enabled. Same thing for sells. They have sell orders at 4,100, let's say. So whenever it goes to 4,100, what happens? The price tends to go lower because the sell orders gets activated. Now, we are not talking about some couple of thousand. We're not talking about some couple of millions. We're talking about billions, about trillions, about really move makers, market makers that tend to move very much of a liquidity right into the charts and right into the markets, okay? So there is a lot of liquidity or a lot of I would say kinds of liquidity that we're going to be covering in this video, okay? So in order to fill these large positions, we have to come to a certain price. Now, what are these large positions? One of the stuff is called buy stops. One of the things is called sell stops. So buy stops is usually resting above the highs that the market tends to make. So with that being said, let's try to show you something. Okay, so the buy stops is where the big institutes tend to push the price higher. So the buying stops are lying around this area. So whenever the price comes to touch these, enables the buy stops, now the big institutes come in the move. The same thing for sell stops. Sell stops are usually below any low. So it's like some sort of lows, not every low. So let's say sell stops are right below this low. What happens? They get enabled, the price tends to push lower because the big institutes are now moving the market. Now that happens in every aspect, okay? So wherever the buy stop is lying, these are called buy side liquidity. And on the other hand, in the sell side liquidity, it's on the low, okay? So here we have a buy side liquidity, here we have a sell side liquidity, then it's the break, we grab the liquidity, now we're moving, okay? Goes both ways, okay? What are the kinds of liquidities? This is very important, okay? So liquidity around like liquidities lie around some sort of areas, some sort of patterns that you're going to be noticing in the markets, okay? So first of all, let's say equal highs. So we have, we're going to jump at the practical, let's just, move it around. So the equal highs are some sort of highs that, let's say, are in the exact same price or a very, very small, let's say, difference in the price between the highs. So these are called equal highs, and sometimes we call it engineering liquidity. Engineering liquidity are in the same spot, okay? So what happens? So these equal highs and these equal lows tend to attract the market. They work as a magnet, okay? Same thing for swing highs and swing lows. But in these, okay, these have some sort of liquidity being built, okay? But these are like very obvious liquidity point, okay? Pretty simple. We're gonna jump in the charts. If there's some kind of confusion, it's gonna be sorted out, inshallah. Previous day high and previous day low, we're gonna be noticing between the days, okay? So we have a high here, okay? And tends to make a new high and tends to make a new low. So on the next day, we're gonna have a previous day high and a previous day low. Okay, so these lows and these highs lie a major liquidity right above and right below. A lot of buy stops, a lot of take profits, a lot of sell orders, a lot of sell stops, a lot of stop losses. So all these are some sort of liquidity that tend to attract the price, that tend to attract the market. Same thing goes for week highs, week lows, okay? Now, in markets, there are some indices that open only in London and New York, and some indices that open 24, and some metals that open 23 hours, okay? But the major things are forming into 3 sessions: Asia, London, and New York, okay? So whenever a session opens, okay, so Asian session makes a high and makes a low, okay? So London session comes wherever it starts, it is tending to break a sort of liquidity, wherever it's the high of the Asia, wherever it's the low of the Asia, okay? And then comes New York, also tending to grab some sort of liquidity. So take this market as it wants to grab money, it wants to grab your money, it wants to grab your stop losses, it wants to go for the big moves of the big institutes, the sell orders and the sell stops, buy stops, etc. So these are the things that move the market. So in order for the market to gain the power to move, it has to go grab some sort of liquidity, okay? But as us, as a retail traders, we have take profits, we have stop losses that does not tend to move the market. It's just some, liquidity that the market wants to go, and we retail traders get in that trap that we place a stop loss right where the sell stops are or the buy stops are, etc. Okay, so let's this is an overview chart. Okay, it's trying to, I made it up trying to come up with all the stuff just in one image, so we're gonna jump on the next stuff. Okay, so we have a moving up market. Okay, we have equal highs here, we have equal lows, okay, turning to another low. Okay, and then what happens? These are having a lot of liquidity behind which is, you know, like under the low, and same thing for the buy side liquidity. Okay, so the sell stops are lying around the low, the sell side liquidity is lying around the lows as well, and the buy side liquidity is usually when a swing high or an equal highs gets presented in the market structure. Okay, and let's say there is a Asia session, Asian high, you know, this is, you know, we're gonna jump in the charts. We're gonna go for the, you know, the practical thing. This chart is just, you know, as an example. Okay. Now this is the most important part. Now, if you did not understand the previous part, you probably should replay the video, because in order for you to understand what's coming, you have to understand the previous stuff. Okay. Now, in the advanced liquidity concepts, and is usually present in the smart money concept and the inner circle traders, which is the ICT, what I'm personally trading, or I'm personally telling people to do, because it's the actual way. Okay, so these liquidities find around a lot of spots that you as a trader should be looking for to watch at least, or take trades right into. Okay, so first thing is the inducement. Okay, so in order for you to move to a certain price, let's say you are making swing high, swing low, swing high, swing low, swing high. Okay, now this inducement has a lot of liquidity right above. Okay, we're gonna jump at the charts. I said that multiple times to identify those stuff. Okay, but let's, you know, take it as a quick. Fair value gaps is usually when a candle tends to open. Let's say this closed here, it opened, and it closed here. There is a gap here that the candles, on the following candle, did not come to touch. Same thing goes here. The candle starts here, it closes here, and there's a gap here. This gap is called liquidity pool. This liquidity pool has some sort of stuff. Let's say a mitigation, let's say filling the fair value gap. Sometimes you're gonna go for the inversion fair value gap, which is presenting on the opposite side. So this is a very important aspect to look for as liquidity. Okay, so yeah, here I'm saying that the fair value gaps act as a liquidity magnets, that they have to be revisited before continuation. You have to understand this, that if you wanna go up, you have to have the least possible, or the little to zero or none, close to none, of liquidity being under the price in order for the price to be only attracted to go up. Okay, I hope you understand this part. So let's say you have liquidity around a spot low, and let's say you have liquidity around a swing low, and you have liquidity around a swing high. Now, if you want to drive up, you have to go sweep the liquidity of the swing low, and then make some sort of fair value gaps as power of the move. But in order to go grab the swing highs, you have to come down to the fair value gap to fill it, and revisit that fair value gap before continuation to going up. So as an example, the price pushed up, a fair value gap here is being introduced. You are not having that much power to go drive up unless you come and fill this gap. It's called a liquidity pool for a reason. Okay, so order blocks are usually some sort of place that we're gonna, you know, break down. I already break down in like two videos before, or something like that. Okay, you gotta go check it up. So the bullish order blocks and the bearish order blocks are basically placed where it has, from its name, order block. It has a lot of orders lying around a certain price that tends to respect or break that order block for the next move. Okay, so these order blocks lie around a lot of, you know, orders. Let's say sell stops, buy limits, sell limits. Okay, the liquidity sweep. Okay, so these buy stops tends to push a lot of liquidity in the markets, and the same on the other part, a lot of take profits are present right in these highs. So let's say some people, or the big institutes or the retail traders, have their buy stops around this area, as long as the buyers from below take profits here. Okay, as long as the sell orders having their stop loss around this area. Now, with all that being said, this is called a liquidity sweep. Okay, so with the liquidity sweep, you are sweeping a certain high that has some sort of liquidities that you grabbed all this liquidity to drive down. This is what I'm talking about, guys. You have to sweep liquidity at a certain point in order for you to reverse to the other side. So in the smart money concept and in the ICT, one of the biggest confluences to enter a trade is to not enter a trade without seeing the liquidity sweep being formed before any kind of setup that you're looking for. Okay, same thing for liquidity grab is going to be basically going back to trigger some sell stops before going to the buy stops if you're going and, you know, in the same market conditions. So you have the liquidity sweep enabling the buy setup, the buy stops, okay, and then you go down to sweep those liquidities, okay, so you do not have something left behind, not revisited, not filled, some sort of liquidity being kept in the market. You have to fill all those before the real move begins, okay. Now this is some simple stuff, some structural stuff that I put just to give you all the info, so whenever we jump into the charts, you guys have the whole image, okay. So you have what's called a breaker structure or the market structure shift. Basically, a breaker structure is happening in an uptrend, okay. That a breaker structure is going to be breaking the swing highs in an uptrend. That's what it should be doing, okay. But a market structure shift is a market in a downtrend, okay, and tends to make a market structure shift to the upside. Now that is change in character, okay. A displacement, it's a strong and impulsive move, okay. It has to show you that the big institutes are jumping in the markets, are jumping in the charts to show you where the price are tending to move. You get it? This displacement usually lie around a lot of liquidity, a lot of fair value gaps that should be revisited, okay. Now that's what happens after all what I said is combined. So you have some sort of liquidity that has been taken, okay, and you made the displacement, and you come back to revisit or fill those fair value gaps or those liquidity spots, okay, and then you start for the expansion. You're gonna go up, but in order to go up, you have to get the power from those liquidity lying under the market, okay. So let's go for an example, okay. So we have here equal lows and we have equal highs, okay. Now we have an uptrend that is pretty obvious, okay. So we have the high here, we have the low, and the previous daily low and the previous daily high is there, okay. Now there's a lot of equal highs here, so the price tends to go sweep that liquidity, but this liquidity was not, let's say, was not enough, okay, to push the price down. So it wants to grab the big liquidity, which is probably going to be the previous daily high or the previous weekly high. I said on the previous thing that these are the major liquidities, the daily and the weekly liquidities, okay. So the price tends to go sweep those liquidities in order for it to enable the buy stops, in order for it to get a take profit for people, in order for you to look for a downtrend, look for a reversal, okay. So after the big liquidity sweep happens, okay, which is going to be the enough move, you're going to see this displacement. This means that the big institutes are finally jumping into the markets to show you the real move, okay. Now this fair value gap is a fair value gap that should be revisited, as we said before, in order for you to go back down, okay. So bearish order block is basically an order block, as you can see, that tends to break down, break up, but then what happens, it tends to break. So it's showing you again that the displacement of the big institutes are strong enough to push the price lower. Once you grab that high, you're looking to grab that low, because guess what, you swept those liquidities. There is no other targets on the upside. There is no liquidity targets on the highs or on the swing highs or on the previous session highs, the previous daily highs, and the equal highs. Now what is gonna attract the market to go up? The market does not want to give money to people. It wants to grab money from people. You have to understand it that way. Okay, now after the displacement, we have a bearish fair value gap formed into the displacement. Okay, so with this displacement, what is happening? You are coming to revisit that fair value gap in order for you to continue lower, to fill some fair value gaps in order for you to come and sweep the other liquidities around. I hope you guys get the whole concept. It's a lot of info. If you want to take a screenshot, you're free to take it. Lovely, lovely. Now with that being said, let's jump into the charts. Let's go for one currency, let's go for one index, and let's go for one metal. Okay, so let's pick something random. Let's go for euro dollar as an example. Okay, so euro dollar, we have weeks. Okay, now with that being said, what is happening? Okay, we have here swing high, swing low. Let's go for the bigger image. Okay, so we have swing low, equal low. We have swing high, swing low, swing high, swing low, swing high, swing low, swing high, swing low. Now what happens here? Okay, inducement. Okay, what happens? We have a liquidity sweep. Okay, so these were some sort of liquidities being around, okay, which is we call engineering liquidity, or let's say equal highs, that the price went to sweep those liquidity. Okay, now what happened right after? We have a market structure shift. Why? Because the market, guess what it did? Okay, the market went to here, enabled those buy stops, took the profits of early buyers and stop losses of the early sellers before the big institutes jump into it. Now, what happened after that? If you can see that, you can see that on the weekly time frame, which is a very, very powerful. Okay, we had a fair value gap here that printed after the liquidity sweep. An inversion fair value gap is basically a fair value gap going on the opposite direction, right in front another fair value gap. Okay, so what happened right that? After that, we have a market structure shift. Now, we're going to be looking for what? Guess what? We're going to be looking for the liquidities that the market are most likely going to go grab in the next weeks or in the next days. Okay, now one of the stuff is going to be this liquidity, this big fair value gap liquidity, and these swing low, these swing low. Okay, now that's on the weekly time frame. Let's jump in the daily time frame, you know, go for a lower image, little lower image. Okay, so again, we have here a what? We have a liquidity pool. We said that these are fair value gaps, right? So these fair value gaps that the market went to retest to grab its liquidity. Okay, after it grabbed its liquidity, it made the displacement downside because it grabbed the initial liquidity to go for the big move. On the other hand, we have here an inducement. Inducement, it's not a low, it's not a high, it's just some sort of price auction or the price structure that tends to put liquidities above because stupid people are guess what, looking to buy once this breaks. This is not a swing high, this is not a structural move, this is just a liquidity grabbing move. So what happened here? We have filled the fair value gap, we have swept the liquidity. Now guess what? We are forming inversion, we're forming, you know, the retracement, and then we're making the displacement, retracement, and then boom, we went down to sweep this liquidity. Now if you were to take a trade, you could take a trade from two spots actually. You would take a trade after this sweeping of liquidity happens and this fair value gap. You could take a trade from this retracement, or even wait for that retracement, putting your stop loss above this high, targeting this low. This is one of the best setups you could ever get because it's structural, it goes with the liquidity, it goes with literally everything. Okay, now we've like take an example on a currency. Let's jump right into a metal. Let's say silver. Okay, do I have anything here? Lovely. So on the silver, what happened? Silver is it's like type shit always, okay? But let's go even in this market structure. Let's look for it, okay? So we have here a swing high being introduced, okay? Now before it moves down, what happens? It sweeps the liquidity, enables the buy stops above these highs, again makes the displacement, and it was very obvious, okay? This displacement shows an inversion on the daily candle. This is very, very, very impulsive and very strong move, by the way, okay? And you're not going to be looking to sell here, you're going to be looking to sell right on the retracement of that liquidity pool, because the market is not going to leave liquidity behind. This market actually is leaving some sort of liquidity behind, by the way, and on the on the bigger frames, let's say the next like a lot of times, like the next year, like months, the next weeks, whatever, you may see the silver coming up to take this liquidity because all the fair value gap is not yet filled. Okay, but we made the whole move as we said. We touched that fair value gap, we made a filling, it's all moved by the liquidities. Okay, now what happens, if you can see here, we had a swing low or even a previous weekly low and a previous weekly high. Okay, what happens here, we came back to sweep that previous daily low or the previous weekly low, and then we tended to go up. But again, the structural move of the big move is yet more powerful because it has more liquidity right lying around. Okay, now we have took a metal. Let's jump into an indice. This is gonna be the end of the video, guys, because we've taken too much, I guess. Now with that being said, okay, we have an uptrend that is very obvious. We have swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high. Okay, now what is happening here? We have a lot of equal lows around this. Equal lows. Huh? Okay. And also equal lows. Okay. This is a lot of liquidity lying around the market. Now what happens? We have a liquidity sweep, okay, which tended to enable those sell stops. Not yet, okay, because why? Because we do not see the displacement, we do not see that the price is going to push higher, okay. Now what happens? These buys, these lows, guess what? The price, oh my god, it's gonna reverse, it's swept the liquidity. Let's buy, put our stop loss below that low. What happens? It tends to go grab that stop loss, go enable those sell stops, and actually show you the displacement. Now again, when in every condition, guys, in every single thing, you're not gonna be, the market does not change its way of moving or its way of everything, okay. So now we printed a fair value gap on the daily time frame, which is very powerful. What happens? We have the retracement of the fair value gap, and we tend to go for the rejection. Now what you're looking for, you saw everything, the liquidity sweeping, the market structure shift, and everything. You're looking for a buy, placing your stop loss here, and actually looking for, this is very tough, and this is very easy. Not that easy, but it's very simple. It's only around liquidities, guys. I hope today's video is breaking down to you guys every simple and every advanced thing of what is liquidity and where does it lie around. And I'm probably sure that on the next videos we're going to be breaking down a lot of other concepts. Just make sure to hit that like button, subscribe, and the bell for the notification if I posted another video explaining to you some sort of concepts or some sort of confluences in the market. I hope you guys really enjoyed that video, and I hope it was, yes, I know it was long, but I hope it was explaining to you every little aspect of liquidity. See you guys in the next video. Let's go.